staying with us. You're watching Investors Guide on ET Now. Dhirendra is still with us in our Delhi studio, and he's about to review the UTI Dividend Yield Fund. Now, Avanne is going to give us a quick introduction to tell us how this fund is different from the other funds in the market, and then we'll come back to Dhirendra and ask him his opinion. Take a look. If you're looking for a fund which shows good returns along with downside protection, here's the UTI Dividend Yield Fund, a big fund in focus. The fund has awarded its investors with an annualized return of 19% since its inception in May 2005. It has navigated through good times and bad to emerge as an impressive performer. The mandate demands an investment of at least 65% of the portfolio in equity shares that have a high dividend yield at the time of investment. Its fall in 2008 was less than that of the Sensex as well as of the category averages, helped by a substantial allocation to debt and cash. Come 2009 and the fund faltered and began to seriously up the equity allocation only from June 2009 onwards. But what has worked for this fund is a smart bottom-up stock picking and sector allocation approach. By doing that, the fund managed to marginally outperform the Sensex and the other two categories in the year 2009 as well. The top three sectors of the fund include energy, financials, and technology. Besides scouting for companies which have substantial cash flows, the fund also looks at capital appreciation potential as the next filter. Using a multi-cap strategy, the fund has put to rest the notion that dividend yield funds can only impress during market downturns. Let's see if the numbers speak for themselves. If you invested 1,000 rupees in this fund when it launched, you would have 2,962 rupees today. Would you reap the benefits if you take a plunge into this mutual fund right away? Our experts will help you to get a clear picture on its performance and tell you if it's a good bet.
But then UTI dividend yield has been a steady performer. It's been a surpriser really for the market because especially in downturns in times like this, it's managed to hold its own. Would you recommend a strong fund like that for investors who are looking for possibly downside protection in this market?
Yes, UTI dividend yield is getting impressive by the day. More so, when we see intermittent steep decline in the market, and that is a time when it has been able to withstand the decline much better. And not to say that, this fund doesn't fall. It does. It recovers faster. It doesn't fall as much. And I think, it is proving to be an outstanding fund if you look at, past 4 years, 5 years, and through turbulence. Portfolio quality looks outstanding. And it is never in the very, momentum, high growth territory of the market. It is never in the pricey segment of the market. So looking at the portfolio, I think it has made a case for itself. I would say that, it's a kind of fund, which should be there supplementing any growth portfolio. So if you have a HDFC Top 200, this fund is very different from that. Even a great fund with long history, it does not help you withstand that the kind of decline where the way this fund has been able to. I would say an outstanding fund. If we are prepared for steep declines of the kind we saw last month, of the kind we saw in 2008, of the kind we see quite often, then this fund should, if we are not likely to see a situation where we will have a market, on the rising steadily and over many years, which we have, which most investors got used to in the phase of, 2003 to 2008. If we don't expect a repeat of that, then UTI Dividend Yield Fund is an essential thing to have in your portfolio.
So can this be my core holding or my only equity holding? If I'm an investor right now watching this market, can I start with UTI Dividend Yield, put maybe 5,000 rupees in this fund every month and use that as my equity holding? Will it be enough?
It can be enough. And the one thing, which you have to really be prepared for with UTI dividend yield kind of fund is that when you see a racy market, when you see the market going up very sharply in a brief period of time and when mid caps and all start doing well, that's the time when this fund will look an average, performer. But volatility, I think it is able to do much better. First time investor and who is wanting to move from a balanced fund can withstand, is ready to get into equity. I think this could well be a first equity fund to start your regular investment.
All right, this could be the first fund that you use to start your investment. And finally, your rating of the UTI Dividend Yield Fund.
I would give it a 5-star for what I have said so far, and also on a risk-adjusted basis, it is in the top 10 percentile in its category.
All right, 5 stars there for the UTI Dividend Yield on Investors Guide. We don't see 5 stars very often, so that fund is obviously a very strong fund that you can consider investing in. But then we have a question that's coming from Kaushal. He writes and saying he's 22 years old with a monthly income of 23,000 rupees. And he has 70,000 rupees invested in fixed deposits, 50,000 rupees in cash right now in his bank account, total invested in ULIPs and in LIC. He wants to know, this is the right time to start investing in the markets through SIPs, through mutual funds. If not, where else can he invest his money? This is a big question that everybody is asking. Is this the right time to get into the market? We've heard this term being used a lot. Will I be attempting to catch a falling knife? Am I getting in at a time when the market's going to slide further? As a retail investor with a salary, with some money to spare every month, how would you recommend investors approach this market right now?
This question is, is the most frequently asked question, that is it a good time to get started or keep investing or invest now lump sum? I would say that, if you are investing in equity for many, many years, and if you are going to be investing regularly, then it doesn't matter. It is always a good time. Important thing is that, you are going to do it for next 10 years. You are going to do it every month or every quarter at, defined periodicity regularly. Timing doesn't matter. And it is very important to get started. It's very beneficial when you get started when the market is like what it is today. You are able to buy cheap. And important, guideline should be that invest your money and don't look at the worth of your money for next 1 year at least.
Also, remember, this is the advice that Virendra is giving you. It's a good time to start, especially if you have a long-term horizon. So think 10 to 20 years and start investing every month right now. This sort of market volatility that you're seeing right now will not matter, especially if you're looking at a 20-year horizon. There's a couple of funds that he can begin investing with. We did talk about UTI Dividend Yield. Is that one of the funds you'd recommend for Kaushal?
Yeah, surely. It's a kind of fund. And if you're investing for the first time and, that anxiety and getting used to it is extremely important, I would suggest that, start with a balanced fund. For your investments to grow, it is important that you start saving. And waiting for that, the best time or the perfect time or when you'll have the real surpluses, and you'll miss out on the time. Your investments need time to fructify, and getting started, doing it regularly, and doing it as soon as possible is the key, rather than, even if, I suggest you a great fund, and it doesn't turn out to be all that great, still the overall difference, in 10 years time frame, even if it turns out to be a mediocre investment, won't be as material. Because, and the magic to the whole thing is your disciplined approach and periodic investing.
All right, Kaushal, start with either the UTI Dividend Yield Fund or a balanced fund. Flashing on your screen are the balanced funds that Virendra has recommended as part of one of our portfolios. You can pick one of those funds and start investing right now. All right, Virendra, thank you so much for joining us on Investors Guide and answering our questions. We look forward to asking you more questions next week. After the break, Vishal Kapoor from Standard Chartered is going to answer more questions that have come in from you during the week, so don't go anywhere.